Hello everyone and welcome to this new video where I will be sharing what I learned regarding the volatility. Um, so we're going to build our understanding from the ground up, moving from basic intuition to the underlying math. And finally, we will check the VIX benchmark. So, starting with the definition. Volatility is simply a measure of risk and uncertainty. The most common mistake people make when defining volatility is assuming volatility means failure or crash. That's false. Volatility only measures the magnitude to which a stock will move, not the direction. So a low volatility asset swings tightly, like in this part, while a high volatility asset experiences massive swings in either direction. So in the stock, it can be up or down. To show this, imagine two stocks that both start the year trading at $100. Stock A on the left trades in a very tight, narrow 52-week range from $45 to $55. Stock B on the right is much more erratic. Its 52-week range swings violently from 5 all the way to $55. This is 50, not 100 here. So from 45 to 55 here, and the mean is $50, and here from 5 to 55 with the mean of 100. Even though they might trade at the exact same price today, stock B carries significantly more risk because of its high volatility. So we measure past risk using historical volatility, which is essentially the math rearview mirror. Technically speaking, historical volatility is the annualized standard deviation of past stock movements. It is crucial to note that this is measured in actual trading days, not calendar days. So 1 month is 21 days, 1 year is 252 trading days, excluding holidays and weekends. So how do we calculate this? The first step is to track the actual daily stock price returns. In this example, we observe the daily percentage changes over a 5-day period for both stock A and B. You can see the day-to-day percentage gains and losses logged here. And then for step 2, we find the standard deviation of those daily returns, which tells us how far the daily movements deviate from their average. Running the math on our 5-day sample, we find that stock A has a daily standard deviation of plus or minus 2.1%, and stock B 1.2%. Finally, step 3 is where we annualize the data. Because the market only trades, as we said, 252 days a year, we multiply the daily standard deviation by the square root of 252. So for stock A, the historical volatility is 32.5%, and for B is 18.4%. But trading is about the future, not the past. This brings us to implied volatility. IV, or implied volatility, completely abandons historical pricing data. Instead, it acts as a crystal ball, forecasting future price fluctuations derived entirely from the forward-looking prices of options. We find this forward expectation in the extrinsic value of an option. Imagine, for example, two $100 stocks. A 90 call option on stock A costs $12, while the exact same option on stock B costs $14. Since both options have $10 intrinsic value, stock A has $2 extrinsic value, which is 12 minus the 10, and stock B has $4 extrinsic value. Because stock B has double the extrinsic value with the exact same time to expiration, the market is pricing the larger future move, which means stock B has higher implied volatility, as we can see from here. So it's vital to remember that implied volatility is pure market theory. It simply shows where the masses are placing their bets. If a big earning report or a court ruling is coming up, traders will bid up option prices. This bidding expands the implied volatility without the underlying stock price ever changing itself. So when you see implied volatility, it's expressed mathematically as a single standard deviation. In statistics, one standard deviation represents 68% probability. This allows us to map market expectations directly to statistical probability. Let's put that into a real-world calculation. If you have $50 stock with implied volatility of 20%, so 20% of $50 is $10. So there is a $10 move. So because the implied volatility represents one standard deviation, this means that the options market expects 68% chance that the stock will close somewhere between $40 and $60 over the next year. That's what we mean by one standard deviation. Now that we know how the implied volatility works for individual stocks, we can look at the macro level. The SIBO volatility index, which is the Chicago board something, or the VIX simply, applies implied volatility to the S&P 500. It aggregates the prices of options expiring in the next 30 days to act as a real-time pulse of the market's forward expected movement. So the VIX is famously called the fear index, but that can be misleading. The VIX is non-directional. It measures magnitude, not the fear. For example, a stable bull market do not guarantee low VIX. If we see the late 90s, the market was raging upward with massive gains of 33%, 28%, 21%. But because the daily price swings were so violent, the VIX was high. So when you see the VIX, let's see, if you're watching the news or TV and you see a VIX quoting number, what does that mean? Let's say like you see 20. That means 20%. So a VIX of 20 means that the options market expects the S&P 500 to move plus or minus 20% over the next year. That's basically what it means here. So 1 year expectations isn't very helpful to, especially for short-term traders. So to find the daily expected move, we use the rule of 16. We divide the VIX by the square root of 252 days, which is roughly 16. If the VIX is at 20 today, so 20 over 16, so this tells us that the market expects the S&P to move plus or minus 1.25 by tomorrow's closing time. So these concepts do not exist in a vacuum. They interact to form a complete ecosystem of risk. Historical volatility represents our past, implied represents the future, and the VIX represents the macro. There is a direct observable relationship here. When historical volatility is high, meaning there have been large daily price fluctuations in the past, let's say recent past, market makers are forced to price higher risk into the future. This drives up the option prices, which directly drives up the VIX. So there is a correlation between these three. At the end of the day, implied volatility operates like an insurance premium. When markets swings violently, buyers are willing to pay a premium to protect their portfolios. Also, if option sellers demand higher premiums to take more risks. Simple supply and demand here, and that's what drives the implied volatility. So to summarize the anatomy of the unknown, historical volatility is the mathematical reality looking in the past. Implied volatility is the market theory acting as the crystal ball derived from extrinsic option prices. And the VIX is the global macroeconomic um, signal measuring the 30-day implied volatility for the S&P 500. So if you take nothing else from this presentation, just remember that volatility is not simply a measure of fear, it's the price of uncertainty. And now let's see a simple coded project on Jupyter Notebook. So in this notebook, we will measure and visualize how the volatile S&P 500 index has been over time using historical volatility, also known as the realized volatility. So historical volatility, as we said in the presentation, quantifies how much an asset's price fluctuate day by day. By computing this on a rolling basis, we get a dynamic picture that reveals a period of markets calm or turbulence. What we will do is we fetch the prices using Y-Finance. We will compute the daily log returns, then apply the 21-day or 1 month rolling standard deviation, then annualize it by multiplying it with the square root of 252, so 1 year, 1 trading year, and then plot it with the matplotlib. So here we will import the data, pretty straightforward. We will take the close, and the ticker here is the SPY or the S&P 500. So to calculate the daily return, it's current return minus last day multiplied by the last day. So each value represents the daily gain or loss. This the first row will be of course empty since there's no previous day. So if this 0, we don't have -1. We will only start from 1 because we have 0. So this will be automatically handled later. Let's run it. And now we will calculate the rolling standard deviation. So as we said, 21 days is 1 month. At each day t, the standard deviation looks at the previous 21 days and computes the standard deviation, and then slides forward by 1 day and repeats. This gives us a time series of volatility rather than one static number. And of course, we will have the first 21 rows with empty values, because we need 21 days to start computing the standard deviation. Now we will analyze it simply by multiplying by the square root of 225. This is the annualized. Now we will simply plot it. So we said here the blue line is the 21-day annualized rolling historical volatility, and this one is the long run average volatility over the period. So we can see some spikes here. So this corresponds to real market events. The spike, we can also consider this as a spike. And here we can see relatively lower volatility in this period. This shows that there is like a quiet period of time in this market. So that's it. This was a very simple concept. See you in future videos.